Good morning, it's Wednesday, March 23rd. I'm Tom Elliott and this is my market report. Well, 2 nights ago the US shares had a big rally and yet our market did nothing yesterday. Last night US stocks fell just very marginally and our market is down today. So the conclusion to be drawn is that confidence, at least amongst Australian investors, is fragile. Our market simply doesn't want to make up the losses it's sustained over the last couple of weeks. And of course, in that time, we've had the well-documented disaster in Japan, overlaid by what's going on in Libya. So perhaps it's no surprise that investors are uncertain about shares and would prefer the safety of cash. Having said that, there's always movement in individual sectors. Uranium stocks have regained some of their losses, although they're nowhere near where they were 2 or 3 weeks ago. Stocks like ERA, Extract and Paladin clawing back some lost ground. Insurance stocks also doing a bit better. Insurance Australia Group and QBE off their recent lows, but again, the insurance sector has just had a terrible time, but globally, you know, what with the floods in 2 parts of Australia, the earthquake in New Zealand, and of course the much more damaging earthquake and subsequent tsunami in Japan. As I mentioned in the past, the cost of reinsurance, which is effectively the insurance that insurance companies use, it comes out of places like Lloyd's that many people might have heard of, but perhaps be a little uncertain about what it actually does. Reinsurance costs will go up, and ultimately this will mean higher insurance premiums for consumers. So something for everybody who's got car or house insurance to look forward to in the next 12 to 18 months. With the nuclear disaster in Japan, many people are saying that this is going to put on hold nuclear expansion for some time, and as I mentioned in the past, after 3 Mile Island in the US in 1979, not one new reactor was commissioned. There was one built on Long Island in the late 80s, but it was never put into action because of concerns over evacuation from that part of the world in the event of an emergency. So many people are saying, well, if not nuclear, what else? And to me, the answer seems pretty simple. It probably means gas. Gas, although it's a fossil fuel, only produces about half as much carbon dioxide per kilowatt of electricity produced compared to, say, coal. And the lucky thing for Australia is we have a lot of gas in the northeastern part of the country, Queensland and New South Wales. We've got coal seam gas. In the northwestern part of the country, you've got the enormous northwest shelf reserves, of which Woodside Petroleum is a major partner. Unsurprisingly, shares in Woodside, Origin, Santos and Oil Search have all been stronger in the past few days. Speaking of oil prices, of course, the confrontation of Libya has driven up the price of crude. Now, Libya only produces about 1.3 to 1.5% of world supply, or at least it did produce that. It's producing virtually nothing at the moment. But world oil supplies versus demand are already so finely balanced that by taking out the Libyan production, it's not easy for other areas such as, say, Saudi Arabia to make up the difference. So oil in the US, $104 a barrel overnight. Locally out of Singapore, where Australian oil is priced and where our petrol prices are derived, oil has hit $122 a barrel. And if you factor that through after excise and refining and all the other things, transportation, you end up with a petrol price of a base level of $1.40 to $1.45 a litre locally for standard unleaded. However, given what they call the weekly petrol cycle, it won't be surprising to see costs at the barrels peak around $1.55. And that, of course, is assuming that oil doesn't go any higher. And if the conflict in Libya is prolonged, or indeed it inflames other parts of the Middle East, well, you can easily see oil prices going higher. Finally, to exchange rates, the $8 has made up lost ground. Last week it dropped to around 98 US cents. This morning it's back to just under 1.01 US, where it's been for a couple of months now. And perhaps more importantly, against the yen, it strengthened dramatically. The yen went up last week as Japanese companies repatriated money to their homelands. But central bank intervention around the world has been aiming to push the yen back down. It's exactly what Japan needs. A strong yen will cripple any hopes of a Japanese recovery. A weak yen will give Japanese exporters like the big car companies a chance to recover. The Australian dollar at the moment buying almost 82 yen, up around about 5% from where it was this time last week.